Hello everyone, how are you all? Welcome back to my channel. I am Dr. Labib from Dr. Labib Academy. Hope you are all doing well. Today we will continue with ACCA Strategic Business Reporting SBR. Okay, and this is the, if you take the series, this is series 8. Okay, series 8 by 25. 25 is just for only a nominal case, okay, for our understanding, but the most important thing is the sequence. We are continuing from where we have left, is it right? We have done to some extent we have done IFRS. Okay, IFRS we have done till step 3 in the previous session. Okay, we have done for step 3, and we have covered around example test your understanding 4. I kindly request you all to subscribe to my channel, share this channel, post your feedback, and watch till the end. And if really it makes any difference, please like the video. Okay, subscribe to this channel so that whenever I post, you will get notifications. Okay, that's very important for us. Coming back to this, where we have stopped is that we have done somewhere test your understanding in the golden key gate. Okay, in the last, that is the 7th one. Okay, now we start with the step 4. Okay, before we start with the step 4, just I want to make sure that what are the conditions criteria with respect to the IFRS. Okay, IFRS is having a 5-step process. IFRS 15 revenue, is it? It is a 5-step process. First is you have to identify the contract. Second, you have to identify what is the performance obligation. You should have a transaction price. Allocate the transaction price to the performance obligation. Okay, this is what we are going to continue from here. Is it? Allocate the transaction price. How you have to allocate the transaction price among the different activities as such. And in the end, step 5 is recognize revenue when the performance obligation is satisfied. This is what we say. What is the same concept? You will have that. We will first understand the concept, and subsequently we will use the test your understanding. What the transaction price? Allocate the transaction. One of the important elements. Okay, criteria. The total transaction should be allocated to each performance obligation. Is it proportionate to in proportionate to stand? Means what will happen? Definitely you will have something with respect to the product, something with respect to the service. Is it? Then we have to identify what is the product cost and what is the service cost. The best evidence of the standalone selling price is the observable price. When the goods, they are made very clearly, when the goods or service is sold separately, means you are buying a product separately, but you will want service also. Is it? Service for the product for the next 1 year. For the means every product as of now, every product comes with a service of 1 year warranty, 2 years warranty. Is it? If that is the case, what we have to do? So in this process, what we have done the identify the contract, identify separate obligation, determine the transaction price. We'll do this. Is a transaction price to the performance obligation. And in the end, we will do recognize the revenue as such. Now coming back to this, as simple as that, you have to identify between product and service. If standalone selling price is not directly observable, means it is very much essential that they should be observed what are the inputs and it has to be maximized wherever it's possible. Is that if there is some discounts are there, this is the point of discussion for a bundle of goods. Then in that case, what you have to do, we have to identify what is the discount with respect to the performance obligations. Okay, what is the discount with performance obligation? A small example is given. It's very important for test your understand. Shred sells a machine, and they are selling a goods, and they are talking about free technical support for 100,000. See, definitely there is no free. Okay, nothing is there. There is nothing like we are getting free of cost. There will be a cost element is there. Fine. With that product, they will sell with the product. They will also selling the service, but the service cost has not been identified. The sale of the machine and the provision of technical support has been identified as means product is different, service is different. Shred usually sells the machine for how much? 95,000. But it has not yet started selling support for the machine as a standard. Means they are not selling any service. They are selling that with the product we are selling. What is the price of the product? Price of the product is 100,000. They are selling at 95,000. They are giving some discount, but it has not been. Very interesting for this machine as a standard. Other supports, see, if they offer support services, what is the markup? Markup is 50%. And they will sell the support services. What is the cost? Cost is 20,000. Means 20,000 is the cost. Markup is 50%. Means 20,000 plus 10,000. It is going to be 30,000. Okay, and they are not selling. If they sell the services, they will sell it separately. Is it right? Now, what they say? What is we have? They have made it very clearly. Observable inputs. This is the solution. Is it? They say observable. What is the observable? Observable inputs or observable evidence. I can say that this is the Kaplan. Okay, I'm using the book Kaplan. Please subscribe to my channel and share this channel. Very important. Observable evidence is how much? It is going to be 95,000. See, the product is worth of 100,000. They are selling it how much? At 95,000. Is it? For the service, is it right? For the service, we don't have any evidence, is it right? No observable evidence. Means in terms of what? In terms of price. Okay, very simple. Is it? It means we don't have it. Now what we have to identify what is the value of the product and what is the value of the service. Is it right? Now, how much they are selling the product? They are selling the product is how much? Usually the usually sells the machine for how much? 95,000. Is it right? If they are selling it for how much? 95,000. Means how much is the value is 100. They are selling it for 95, and what is the difference of how much? Difference of 5,000 is nothing but residual. Fine, it is nothing but residual. Now, fine. This is what the cost of the product, including service. Now, what is the service cost? Make it a point. Okay? We have to identify what is the service. Service cost is 20,000. Markup is how much? Markup is 50%. Is it? Markup is 50%. It comes to how much? 20,000 times 50%, it comes to 10,000. Means what is the cost of the service? Selling of the service, it comes to how much? It comes to, this is the selling price. Selling price of service. Okay? Selling price of service. Now, what is the total selling price? See, step by step, very easy, is it? Total selling price will be how much? Total selling price will be product will be 95,000. Service will be how much? Service will be 30,000. It comes to 125,000. Is it? Now, what IFRS 5 says, that's very important, okay? What IFRS 15 will say. When IFRS 15, that discounts relate to all performance. See? This is not discount, not is related only to the product. Discount should also related to the service. It says that discounts, is it right? Discounts relates to all performance. Okay, discount relate to all performance. Unless until we are going to say that discount, unless it is evidence exists. Unless it is evidence exists. Okay. Now, if you take into consideration, what will happen? They say that what is, if you take into consideration how much is the discount we have to identify, is it? Total price is how much? Total price is 125,000. Is it right? Total price is 125,000. The free technical support is how much? 100. Now, what is the discount percentage? Discount percentage is how much? See, discount percentage is, I will write here for our understanding. Okay, discount percentage is, see how much is the discount? 25,000. Okay, this is the discount. Okay, this is the discount. What is the total price? Total price is of the product. Is it a total selling price will be how much? Selling price is this is the selling price. Fine. So we have to calculate discount percentage. Discount percentage will be how much? 25,000 divided by what is the total price? 125,000. Means discount is how much? Discount is, it comes to 1/5 or 20%. If converting it into percentage. Fine. If it is converted into percentage. Now we have to give 20% discount on the product and 20% discount on the service. Okay, we have to give, means product discount. Okay, product discount, net product price, is it, with discount. It comes to how much? 95,000. Is it? It comes to how much? 95,000. Discount is how much? 20%. Is it? 95,000 into how much? 1 minus 20%. 1 minus 0.2. Okay. 1 minus 0.2. 1 minus 0.2, 20% discount. Okay, it comes to how much? It comes to 76,000. Whereas net service provision, is that technical support, is that net service provision price, with discount only, is that with discount, it comes to how much? It comes to 30,000 1 minus 0.20, it comes to how much? It comes to 24,000. It comes to 24,000. Means like this, we have to recognize the performance obligation. How much is that? See, we should not say that yes, product is coming with 100,000 and they are giving a discount as such. No, we have to take what is the price of the product, what is the price of the service, and what is the discount total price we will take. Once we are taking the total price, then subsequently we have to identify what is the how much it is related to the product standalone. This is called as a this is called as a what? This is called as a standalone. Is it? Standalone selling prices of goods and services. Very interesting, very simple. Okay, it's not difficult. Where there is a difficulty level, I will tell you this is the difficulty level. You have to be very, very cautious. Coming back to the last step, step 5, recognize revenue. When we have to recognize revenue, this is the most challenging thing that is happening. Is that customer payment is not the trigger point. You are paying the amount is not the trigger point of the recognition revenue. Even the such payments are, in some cases what will happen, some payments are non-refundable. Is that this is where the critical issue, where it is refundable, where it is not refundable. The point is customer is not the trigger point for revenue of recognition. Take it very slowly, understand it very clearly. Okay. Instead, revenue is recognized when the entities satisfy the obligation. See, you have to satisfy the performance obligation has to be satisfied by transferring the promised goods or services to the customer. Then only it will happen, is right? I cannot say that I have taken money and that money is a revenue for me. If I have taken money and if I am not performing it, definitely I cannot claim right of that money as a revenue. An entity must determine the contract at contract inception in the beginning whether it satisfies the performance obligation over time or over a period of time or at a point of time, means at which point we are going to satisfy. See what happens in some cases. We will take, this is the stage 1, okay, this is the stage 1, this is the stage 2, is it? This is the stage 2, this is the stage 3, is it? This is the stage 3 and this is the stage 4. Now what happens is that you are ordering, you see what happened, car makers order the cars at the beginning of the at the time of the contract. Aircrafts, you are ordering Boeing aircrafts. When you are ordering Boeing aircraft, you have to pay. Now that much amount you cannot pay at once. Okay, you have to pay in per parts. Okay, sometimes there will be a condition that if you are talking in terms of the thing, you have to give some deposits here and you have to pay proportionately. As you very clearly, 10% is the signing amount. You are going to pay 40% at stage 2. Is that you are paying at 40% and the remaining 50% at stage 3. Some people say every other combination exists. Okay, every other combination exists. In some cases, what will happen? They say that no, it is not like that. You have to pay 50% at the time of signing the things and 50% at the time of completion. In some cases, again, there will be a different way, okay? There will be a different way. They say that you have to pay refundable deposits. Is it? You have to pay the refundable deposits. Sometimes it will be included, sometimes it will be excluded with respect to total amount. Is that if contract is completed, fine, you include the refundable deposit in the contract. If contract is not completed, definitely you have to forego that deposits. Okay, these are the nitty-gritty things in this respect to a performance obligation. The IFRS 15 para 35 says that the entity satisfies a performance obligation over the time if one of the criteria are met. What are the criteria? The customer simultaneously receives and consumes the benefits. You are receiving and you are consuming the benefit. Very straight point of time. There is no point of discussion. Is that it's give and take at one point. The entity performance create or enhance an asset. For example, work in progress. I told you it will be in different stages. Is it right? It will be in different stages. You will have first stage, work in progress, finished goods, and the end of the time of delivery. Then the customer controls and assets is created over or enhanced. Yeah, a customer controls as the asset is created. This is or enhanced. Fine. Next, the entity performance does not create an asset with an alternative use to the entity. It says that they have the entity has an enforceable right to payment. This is very important. The entity performance does not create an asset with an alternative use to the entity. Means it is going to be a specialized one. Fine. It is going to be a specialized one. And the entity has enforceable right to payment. Means you are completing this much percentage, that much percentage you have to pay. See what happens if you are completed 0, if you are completed 40%, you have to oblige to pay 40%. If you are completed 75%, you have to oblige to pay 75%. If you are completed 100%, you have to pay. It happens because what happens, most of the contracts will not be a short term. Most of the contracts will be long term, which will go beyond. Is that go beyond 1 year till, is that, let's say we can say 5 years, 10 years. Is that 5 years, 10 years, as many as possible, maximum 5 to 10 years. Okay, if that is the case, we have to be very that is what the revenue component says. What is the, you have to realizable concept. When we realize, it has to be reflected. Matching concept, matching revenue with the cost. See, concepts have to be very clear whenever we are talking about the financial statements. Okay, if performance obligation is satisfied, then the revenue recognized over time based on the progress toward the satisfaction. What they say? If over time, how much is, if it is performance is 40%, restrict 40% only. If performance is 100%, take 100%. If performance is 20%, take 20%. Again, in this, what will happen? Definitely assume they are giving a discount of 10%. Now, this 10% is applied to full contract, but the moment you are receiving only a performance obligation is only 40%, this 10% is applicable for 40% only, subject to the performance obligation. The most important thing is we should understand how the performance obligation will be understood and will be applicable. Okay, this is where the concept will say. Now, see the things, how it will work. On January 1st, is it on January 1/1/2001, E1 enters a contract with the customer to provide monthly payroll. See the thing, they are very clearly, they have a contract for but the condition is they will pay monthly. And how much they will say they will charge? They will charge how much? They will charge 1,200, is it 120 per year. See, they are charging for per year, but they will pay monthly. If they are charging per year and they are going to pay monthly, fine. Required, what is the requirement? What is the accounting treatment of the above in the financial statement for the June 2001? Means they want till June 201. Okay, means how much they want? They want only for 6 months. Okay, they want only for 6 months. If that is the case, very simple. Is it that? Very simple. 120 times 6 by 12, it comes to 60,000. This much amount should be recognized as revenue as per IFRS 15. Right? As per ISRF, means you have to be very, very specific. See, if you have clarity on these concepts, I can assure you that your questions will be very, very specific. You can do it very easily. Test your what they say. On March 31st, 2001, fine. On March 31st March 2001. Crawford enters into a contract to construct a specialized factory. That is very unique. This is one of the conditions. Is it? This is one of the conditions with respect to the IFRS fund. IFRS 15. Isn't it? The entity, what they said, the entity performance does not create an asset with the alternative use. Point number C, recognizing revenue. You should not create an asset with a alternative use. It means you have to create an asset with a specialized one. Is it? With a specialized one. That's fine. 31:12. The customer paid an upfront deposit which is only refundable if Crawford fails to complete. That they have to see, the customer has paid. Is it right? Customer has paid and deposit to Crawford. Okay, Crawford. If which is only refundable if Crawford fails. If you have completed, then there is no refundable. Is it? If it is incomplete, is it? If it is incomplete, then only it is a refundable. If it is, understand point, if it is complete, it is not refundable. If the remainder of the price is payable when the customer takes possession of the factory. If the customer defaults on the contract before the completion of the factory, Crawford only has the right to retain the deposit. See the thing. What will happen if the customer is defaulting any money? Okay, the thing is, it have the advantage on both the sides. If it is completed, Crawford has the right not to refundable if it is incomplete. Now, if customer is defaulting, then what happens if customer says that after some time customer will keep quiet, he will give up. If that is the case, then whatever the amount has been deposited, that it will be retained by the Crawford. This is the normal situations that always happens in the business terms and conditions. Now, what it says, should Crawford recognize revenue? Is a first and foremost. Is that first and foremost is it is no alternative. Is that they say that it is a specialized factory. Is it? It is a specialized factory. No alternative use. Yeah? Now, what Crawford says, Crawford has only enforceable right, is it right? Has an enforceable right to enforceable right to the deposit received, is it? They have only a enforceable right to the deposit. Means definitely they can enforce it, and they don't have a right to payment, is it? They don't he has only the enforceable right. That's all, as simple as that. Now, what is the third one? Is it as per the performance obligation, Crawford must account for the sale of the unit as the performance as the Crawford should recognize. Is it right? Must account it for what? Must account it as performance obligation is satisfied at a point in time. This is very important. Okay, at point in time. Is it? Once what the condition says, if as customer takes possession, is it? Takes possession of the asset at the completion, is it? Possession of the factory, is it? Possession of the factory. What will happen? Then revenue will most likely to be recognized. Is it? Revenue most likely to be recognized. These are the things we should be. You have to be very, very clear when we should recognize, when we should not recognize. Getting the deposit, fine. The amount whichever is received, the amount whichever is going to be paid will have, most importantly, have some attachments. If there are some attachments, there are some tax, you have to be very carefully work it on. We will cover this with respect to number. Methods of measuring progress. There are two different methods. One is your output method. One is such as surveys of performance or times elapsed. Some are input method in terms of how much we have incurred cost as a total percentage of cost. Is that if progress cannot be measured, then revenue can only be recognized up to the how much we are recoverable cost. Is that if progress is not there, if we cannot say that, fine. If progress is not there, we cannot see that the progress is measured. Is it right? Progress is measured in measured in terms of percentage. Is that in terms of percentage? If that is not possible, then what is the alternative? The alternative is we have to recover based on the recoverable cost income. Fine. Now, another interesting and very important one. On January 1st, 2001, Baker enters into a contract with the customer to construct a specialized building. No alternative use. How much? 1/1/2001. How much it is there? The cost is 2 million. Very simple, very straightforward, very small. Plus a bonus of how much? If the complete is plus bonus. Okay. How much is the bonus? But there is a condition. Is it right? There is a condition that how much is the bonus? Bonus is 0.4 million. Okay. Oh, the thing is if completed on time. Is that if completed on time? What is the estimated cost? Estimated cost is how much? Estimated cost is 1.5 million. If the contract is terminated, if the contract is terminated by the customer, baker can demand a payment for the cost incurred to date plus that. Means if it is happens in, if the contract is terminated, the baker can have the can recover from the customer how much cost plus 30%. Is it right? It is recoverable from customer. On January 1st, 2001, as a result of factors outside its control such as weather and regulatory approval, baker is not sure whether the bonus will be achieved. Fine. They say that it is not expected. It is not expected to be completed. Is it right? Within, not expected to be completed within the time frame. Okay. Now, what is the condition? If it's not done, you have to recover proportionately to the completion, the cost incurred. On 31st December, is it? On 31st December 2001, baker is still unsure whether, still it within still only how many months are there? Only 12 months are gone. Whether the bonus target will be met, baker decides to measure progress towards completion. Cost incurred on the contract to date is how much? Cost is how much? 1.5. Total cost is how much? Estimated cost is 1.5 million. Cost to completion is how much? Cost to completion is 1 million. Okay, cost is completion to 1 million. It's very specific. Is that means how much is there? If you take the performance obligation, is it right? If you take the performance obligation, if you take the performance obligation, is it? If you take performance obligation in terms of what? In terms of cost. In terms of cost is how much? 1.1 million divided by 1 million has been completed. Total cost is 1.5 million. It comes to how much? It comes to 2/3. Is it? From revenue, take 2/3. Is it? From the revenue, how much you have to take? Revenue 2 million. 2 million into 2/3. It comes to how much? It comes to 1.3 million. 1.33 million. Okay. 2 divided by 2 divided by 3. It comes to 1 2 into 2 divided by 1.33. Okay, it comes to how much? 1.33. Cost also, is it right? Cost also how much? Total cost is 1.5. Here also you take 2/3. It comes to how much? It comes to 1 million. Fine. And the how much you have to recognize? We have to recognize how much? We have to recognize to the extent of how much? Gross profit is how much? Gross profit is 0.33. Understand my point? Means if it is based on the inputs, is it right? This is what? This is based on the. This is based on what? This is based on inputs. How much is the cost? Proportionately to the cost, we have to recover the amount, and proportionately to the cost, we have to identify the gross profit also. This is where if the performance obligation is not satisfied over time, then it is satisfied at a point. The entity must determine point in time. An entity controls an asset if it is directly used and obtain most of the remaining benefits. What they say that control also includes ability to prevent other entities from means exclusively benefits should be. Then there should not be any benefit that is going to be shared. IFRS 38 provides the they provide the criteria for transfer of control. Entity has the right to payment for the asset. Means once I have the right to pay for the asset, nobody has other rights, means it is going to have a direct impact. The customer has legal title of the asset, means is exclusive rights. Is it? The entity has transferred the physical possession of the asset to the customer. The customer has the significant risk and rewards of ownership. Means that, see, when you are transferring when you have the right to payment, you have the legal title, you are the owner, you have taken the possession as a customer, you have taken the possession of the asset, and definitely when you got the legal title to the asset, the customer has to take the responsibility for significant risks and rewards of the ownership, and the customer has accepted the asset. Fine, very, very simple. See what happens. Yes, I'm buying the asset. When I'm buying the asset, I will have the right to pay that. Automatically what will happen? It will not happen. Sometimes how the things will work. That's very, very simple. Is it? How the things will work. Whenever you have you have purchased any asset on a loan, okay? When you have the purchase any asset on the loan, what will happen? The ownership title, legal title will be yours, and you have the risk and rewards. Okay, you have the risk and you have accepted you have bought a car on loan, or company has bought plant and machinery on loan. Is it? You have the present right to payment. Is it? The company, the individual, very, very clearly, the individual or the firm has the right for payment. The asset will be transferred to have the legal title. Is it? The customer will have the legal title. The physical possession is transferred to the customer, and whatever happens, the customer will take the risk and rewards, and the customer is accepting the asset. Very, very clearly, this happens. See what this happens because once the asset is sold, there is no return back. Fine. And at that point in time, this is where the most important thing. At that point in time, is it right? IFRS 15 revenue is recognized. This is very, very specific whenever we are going to discuss. Very specific, okay? Now, what it says on 31st December, Clarence delivered the January edition of the magazines with a total sales value of how much? See, this happens whenever you are selling, the publisher will sell. Is it? Publisher will sell. 31st December 2001. The Clarence, is it? Clarence has delivered the next month edition, okay? January edition of the magazines with what is the total value of sales? Total value of sales is 100,000 to a supermarket chain. Legal title remains with whom? Legal title will remains with the supplier, okay? With the supplier. See here what will happen? The supermarket, is it? The supermarket only what it does? It takes into consideration the magazines, and they will sell it to whom? They sell it to customers, okay? Definitely. Now role of supermarket is also very important, okay? So what the supermarket will do? until the supermarket sells the magazine to the end customer. Okay, the supermarket will start selling the magazines from when they will start selling the magazines from 1/1/2002. Any magazines remain unsold will be returned. See, that's it. Unsold magazines, isn't it? Unsold magazines, is it that? Unsold magazines will be, what will happen? They will be returned to whom? They will be returned to the, as simple as that. Okay, at the end of the day, whatever is not sold, it will be returned. As a supermarket will pay only to those magazines which has been sold. The supermarket will invoice based on the difference between number of issues they receive and number of issues they return. Is it? Means what will happen? Sales. See, now you can understand. You will have the sales. Is it right? You will have the sales returns. Is it? You will have the sales returns, and this is going to be the net sales. Is that where is sales? Sales is 100. Sales returns is 5. Net sales is how much? 95. Okay. Now, what should clearance recognize revenue from the above transactions with respect to 2001? Is it? Now, what are the conditions? Is it? What are the conditions? See, here what happens, the performance obligation. Is it? See, the entire thing is on performance obligation. Is that? The entire thing depends on performance obligation. The performance obligation is supermarket does not simultaneously receive and benefit from the asset. Is that? Supermarket is not receiving the supermarket. Is that? Supermarket does not match. Is it right? Does not make simultaneously receive and benefit from the asset. Is it? Simultaneous receive and benefit. Because supermarket will benefit only when the magazines has been sold. Is it right? If the magazines are not sold, supermarket will not have any benefit. Okay? What happens to the clearance? Is it? What happens at point in time will recognize. See, when they will recognize IFRS 15. Is that point in time? Is that when it is transferred the control of assets? Is it when it is going to be when the control of assets? Is that control of assets transferred to the supermarket? Is it? Now you see the thing. The supermarket has a physical possession of the magazines. Is it right? That the control has been passed. Also, clearance. What happens? The supermarket, if any, the clearance will invoice. Is that the 1 minute? Okay. Now, what happens? Supermarket. See the thing. Supermarket have the control over the assets. Any damage, supermarket will bear the risk. Is that supermarket? Anything happens. See, I am supplying 20 products. Okay, you have sold 5, 2 has been damaged. Automatically, what will happen? That's not my job. Is that? That is the reason in most of the places, whenever you visit any malls, any departmental stores, any place, what will happen if there is anything related to breakable things? If it is going to be broken by the customer, fine, it means the product is sold. If anything happens from the customer side, they mention very clearly instructions that the product is treated as sold. That is the reason. In some cases, in other cases, or in some cases, what will happen? If something happens, fine, they will make it as a damage. You just practically experience how the things will work in the market. Fine. This is what it says. Now, the next point. Any unsold, is it right? Any unsold magazines will be returned to clearance by supermarket, subject to damage or obsolescence. Is it obsolete? CEN obsolescence. Anything has been damaged, it is a risk of the supermarket. It is not the risk of the, because initially it has been transferred to the, now it is under the jurisdictions of the supermarket. Supermarket has to take care of those assets. This paper should not be turned off. It should not, see, we will keep the magazines in the folder, is it right? In the plastic folder. Definitely what they will say, they will say that if you open the seal, it is going to be treated as sale. Few others, what will happen? People will come, people will read, and people will keep it, and people will go. There is no point of having a concept of selling, is it right? So they say very clearly that the seal should not be broken. The seal should not be, if the seal is broken, it is treated as sale. Okay? If the seal is broken, it is going to be treated as sale. See, these are the things which we have to be very, very clearly identify with the concept. Okay, fine. This is with respect to point in time. Sometimes, next one. Sometimes an entity delivers the product to a dealer, and then the dealer will make the sale to the customer. Fine. This, you will have the entity, you are giving it to the dealer, and dealer will sell to the customer. See the terms and conditions. Associate the transaction between first entity and the dealer must be assessed to determine whether a sale has occurred. If the control of the good has not passed to the dealer, then the transaction is known as a consignment arrangement. And see what happens, this is where the point is that if the control is not passed, is it that if the control is not passed, is that control is not passed to the dealer, still the entity has the control over the asset, don't treat it as a sale, revenue. Don't treat it as a revenue. Means the control has to be passed to whom? The control has to be passed from the dealer to the customer. Then only IFRS 15 revenue can be treated. Key indication that the transaction is a consignment. The product is controlled by the entity until a specific event happens. And what is the event? The dealer selling the product to the customer. Either you sell the product to the customer or expiration of the specific period. Is that means the control of the until a specific event happens. It has to be sold to the customer, or there is expiration of the period. The entity can require the return of the product, any unsold product. Is that any unsold product? should be returned to the entity. Any unsold product with expiration days, whatever the condition. The dealer has no unconditional obligation. This is not unconditional, it is a conditional operation. Conditional operation means it should go forward. Okay, conditional operation means it should go forward or it should go backward. Very interesting, is it? This is the transformation that's happening from IAS 18 to IFRS 15. Okay, this is a transformation. It's not a direct point-to-point sale where we are just working out on that. Fine. Now, coming back to this. Gazebo is a company that sells furniture to garden centers. Fine. Make it very, very clear about it. Gazebo will send it to whom? Well, they will send it to the garden centers. Gazebo retain the title and the garden center sells the furniture to the end customer. See, once we have completed this, then we will move to the examination question. But very important, if you understand this, the question, practice questions are very easy. At which point the garden has an obligation to pay gazebo. The garden center can return the unsold products to the gazebo, and gazebo can recall unsold products at any point of time. Usually, is it right? Usually, in most of the cases, I will take example of car makers. Take the example of car makers, Toyota, Mitsubishi. If any fault is there, is it right? Any fault is there, what will happen? Car makers will call back the products. Any manufacturing defect is there. Is there any manufacturing? If they will get what is the dealer? Dealer is nothing but if you sell the product, pay to accordingly. If you are not selling the product, there is a conditional transaction. Sometimes what will happen? There will be a entity, there will be a dealer, there will be a customer. Okay, there will be a customer. Now what happens? Dealer has purchased from the entity and there is no going back. Okay, most of the thing, cars you take. Now it is, to assume it is 2023. Okay, we have taken the cars we have bought the car, dealer has ordered the cars and the make of the car is 2020. Now they cannot they cannot return the cars back to the entity. What they will do, the dealer will give some offers. Is it right? Dealer will provide some offers in terms of pricing and say that yes, 2020 model will be 20% discount. Is it? And 2023 model is no discount. See, I will give you this example. Wherever there is a discount, see, on new arrivals there is no discount. Is that? On new arrivals there is no discount. On clearance sale, is that? On clearance sale they will offer discounts. Therefore, offer discount. See, this is the mechanism that works around whenever you will have the sales. Is that? This is the mechanism. By understanding, test your understanding, you will have multiple options how it will work. Fine. Now what they say, unsold products to the gazebo, and gazebo can recall products any tender. Discuss when gazebo should recognize revenue. Right? When you can recognize revenue will be recognized when gazebo, is it right? The gazebo transfers, is it right? Transfers control of the asset. When it's okay. If okay, it's only, see what happened, the garden centers, is it right? The garden centers has possession of assets but no control. Okay, definitely. Gazebo still has the right to use, direct use. Gazebo has right to recall. Is that also there? Gazebo has the right to recall. Yeah? Gazebo has the right to recall. Gazebo, is it right? Gazebo should recognize revenue. Is it right? Recognize revenue when garden center sold. You can put sell the furniture to the customer. This is where we have to be. This is where we have to be very, very clear about the things, how it happens. Okay, next, what it says. Now, sometimes what will happen, a contract is going to be modified. A contract modification is a change to the scope or price of the contract. If there is a contract modification, a modification is accounted as a separate contract. Old contract will be replaced with the new contract. Okay, new price, new terms and conditions. Okay, old contract will be replaced by new contract, terms and conditions. The scope of the contract increases because additions are distinct goods and services. The price increases by an amount that reflects the standalone selling prices. Fine, these are the things with respect to separate. If not accounted as a separate contract, the modifications will be what? The termination of the existing contract and creation of a new contract. You forget about the old contract and everything should be termed as a new contract if the remaining goods and services are distinct from those transferred before. That means if there are new something, see what happened, new versions will be there, new specifications will be there. Then what we have done a contract in the year 2020. Now 2023, 2020 we have a contract with what they will say that we are going to supply for the next 5 years. Is the next 5 years. 2023 they say that yes, things are changing. Definitely what will happen, we are going to modify, prices will increase, specifications will increase, is that prices will increase, there will be new technology, new specifications, is that there will be new requirements, is that as requirements as per the market, is that then definitely we have to think of the original consideration unrecognized, and the transaction price for this new contract is the total of the original consideration recognized and any additional consideration promised from the modification. Means definitely there will be a change in the transaction price. Part of the original contract, if the remaining goods and services are not distinct from the transfer from before the modification, so part of the single performance means We should know whether the performance obligation is different or not, or the things are remain same. Then according to that we have to work it out. The reporting entity, a construction company, enters the contract concern commercial building. 1 year later, both companies agree to modify the contract by changing the floor plan. Definitely the floor plan will increase or floor plan will decrease. This resulted, definitely you are changing the construction, it will change the contract price. The remaining goods and services to be provided under the modified contract are not distinct from the services transferred before. The things only what happened, the prices are same but the area has been increased, something plus or minus. This is because the contract still contains one performance obligation. What is the performance obligation? To construct the building. Consequently, the reporting entity accounts for the contract modification. It is a part of the original contract, is it? But what is there? There is a cumulative catch of adjustments will be required. Means the obligation is you have to make a construction. Construction will remain, construction be there, but only thing is you are increasing changing the modification, is it right? Modification of what? Modification of floor plan. If we are doing a modification with respect to floor plan, accordingly we have to work it. Salty enters a contract to supply 1,000 products. Okay, 1,000 products for sweet at the rate of how much? At the rate of 60. The products are transferred over an 8-month period. Is it? It has going to transfer with 8 months period. After Salty has transferred 700 products. After Salty has transferred 700 products, the contract is modified to require an additional. They say that yes, their contract they have modified. See, the basic rule is you are selling, but after 700 days they have modified to add how many products? An additional 200 products. The price of the additional 200 products is how much? It is 57. Which is a standalone selling price at the date of the contract modification. By the reporting date, Sally transferred how many products? 900 products in total. Yeah? Now, when we have to make sure of this, see, follow the things. The contract modification is a change in the scope or price of the contract. Fine. What is the contract? The scope is how we are talking in terms of 1,000 products. This is very important. Okay, we are talking in terms of 1,000 products. Previously we have given for 60. Now we are selling it for 57. The modification is accounted for as a separate contract. This is a separate contract. The scope of the contract increases because addition of distinct goods. It is a distinct goods, isn't it? When we are doing the thing, the scope has been increased. Instead of 1,000, it is 1,200. The price increased by amount that reflects the standalone selling price. The price has been changed, isn't it? The price has been changed from 60 to 57. Fine, plus or minus. If that is the case, we have to treat it as a separate contract based on these terms and conditions. Okay, based on these terms and conditions, very, very specifically. Why I am putting the things is, I am putting the things because you should have a clarity on what basis we have done. Is it? On what basis we have done? Contract modification is a separate contract because it has a distinct features. because it is a distinct features, and the price increases reflect the product, and the price is a standalone price. See, I'm just giving you the things how it will work. It is a standalone price. Now, what is the revenue? Is it how much is the revenue on reporting date? When it has been done on the reporting date, the price of the 200. By the reporting date, how many they have transferred? Reporting date they have transferred. Sold how many products? 900. Fine. Reporting date. Reporting date. Reporting date is how much? Reporting date 900. 900 into 60. It comes to how much? 54,000. Contract modification. How much they have sold? They have sold as per the old contract. How much it is there? It is the 700 times 60. Is it right? As contract was as per old price. How much it will come? It will come to 42,000. Fine. It comes to how much? 42,000. Next. Next. How much is remaining? 42,000. Fine. Next. How much they have sold as per the fine. Okay. Unrecognized element. Is it unrecognized element from original contract is how much? From original contract is how much? It is 300. Is it? It is 300 products into 60. Is it? It is 300 products into 60. It comes to 18,000. Fine. And how much is additional consideration we have to take? They said that fine. Now, sorry, this is A. Fine. Report as per discussed with calculation how much revenue should be recognized in the relation to the above at the reporting date is 54,000. I just missed that. Point number 2, discuss with calculation how much revenue should be recognized in relation to the above by reporting date if the contract specific price is how much? 40 for the additional 200 products. For the additional 200 products is how much? 40. Assume that the normal standalone selling price is how much? Is 57. Okay. For the additional prices is how much? It is going to be additional products. 200 times 40. It comes to how much? 8,000. Total comes to 26,000. Okay, total comes to 26,000. And what is the price per product? Price per product is how much? Price per product is 26,000 divided by 300 plus 200 additional product. 26,000 divided by 500. 26,000 divided by 500. It comes to 52. It comes to 52. Fine. Now, how much is that? Fine. It comes to how much? It comes to 52 per product. Now, how much they are going to recognize this? Is it how much they are going to recognize this with respect to revenue? The older version 42,000. They have 42,000. Is right? This much is the 42,000 is there. 42,000 as price as per old contract. Is it right? Price as per old contract 300 times 60. It comes to how much? 42,000. It comes to a price as per new new extension contract. Is it right? For new products 200 times how much? 200 times 52. Okay, which we have calculated price per product. We are calculating only for the additional 200 products. It comes to how much? 10,400. Total will be 52,400. Total will be how much? 52,400. This is the contract should be recognized in relation to what? Revenue should be recognized in the year. How much? This much is the revenue. Revenue to be recognized. If the contract price is 40. Okay? No. That's right. The last one, contract cost. If IFRS 15 says that the following cost must be recognized as an asset when it is going to be capitalized. How you have to, the cost of obtaining the contract, this must exclude cost that would have incurred regardless whether the contract was obtained or not. Is it? Means this has to be incurred. So what are the costs? You have the legal cost, you have the cost of travel into the country. Should be excluded. Means you should not take, see, this is excluded. It is, see, you are going for a contract, you will have some legal fees, you want to know whether the legality of the terms and conditions are, you will take a legal opinion, okay, that has to be excluded. The cost of fulfilling a contract, if that doesn't fall within the scope of another contract such as IS2, the entity expects them to be recovered. Means that the thing is, if it is not falling within the scope of the contract, is it? It is not falling within the scope of the contract, such as what? Inventory. If that is the case, then the entity expects them to be recovered as such. Means why it is inventory. Inventory happens only when you are making a commitment and you are starting the contract. Okay, the moment that inventory comes as an input cost at the second stage, not in the first stage. That is the reason we should think about the capitalization. The capitalized cost of obtaining and fulfilling a contract will be amortized to the statement of profit and loss account as revenue. Means it will be amortized as the revenue has been identified. What is that? General cost, wastage of materials are expense to profit and loss account. That is the basic thing, is it? Now, strangers offer consultancy services. It incurs the following cost on the successful bid. How much is the external? See, external fees incurred. Research potential. How much it is there? 13,000. 30,000, fine. Travel cost 20,000. Commission to the sales staff is how much? 15,000. We discuss with the above which of the above cost you can be capitalized. If you take into consideration, see, the rule says that the research cost should be expensed. Development cost capitalized. Research cost is expense. Travel cost as per IFRS should be expensed. Whereas commission to sales staff, see, once you have won the sales bid, once you have won the sales bid, means definitely you are entitled to go ahead with that contract, is it? Once you won the sales bid, what will happen? The contract price will increase. When the contract price increasing, we need to capitalize. Means which one we can capitalize? We can capitalize how much? We can capitalize only 15,000. Okay? That's the simplest way. Presentations of how the presentations of statement in financial positions. Fine. Just I'm going it the same concept how it is. Revenue is recognized from the contracts with customers. You have to disclose it. Contract balances, how it is going to be obtained. Any significant judgments, any changes, it has to be declared. See that? There are various different judgments are there. Judgments differ from situation to situation. Just go through it. The contract can be accounted if there is a probability that the entity, I'm talking about the second one, is it right? The second one. If the entity will collect the consideration that is entitled, whether benefits are probable, is ultimately or it is judgmental. They have given various different judgments with respect to the management process of recognizing the revenue. Okay, this is related to IFRS 15. Okay, this is related, we have completed IFRS 15 revenue. Very, very important and very, very significant. In the next session, we are going to cover with respect to another important concept of non-current assets. Okay, so I kindly request you to go through the things in detail, work out the concepts. Everything is supported with a test your understanding with explanation. And if you are thorough with these concepts, the next phase will be very, very easy for us. Okay, try to subscribe to my channel. It's only it will benefit, and share this channel within the group who are planning to write examination of SBR, and I will continue to post the things according to the sequence as it happens. And most importantly, when I am doing this, I will put the serial number, okay, a series number, fine, for your understanding. Take care, best of luck. See you next session. Thank you so much.